Thank you, Adair. Hope everyone had a wonderful weekend. So we've got the European markets opening the week off with defensive notes, some global, I would say a dual macro threat. We've got energy shocks, of course, of renewed tensions in the Middle East, as well as a tech-led global valuation reset, especially off that SK Hynix debut last week Friday. So we take a look at some of the indices. Stocks Euro 600 pretty much flat, but to the downside. Powerful energy push barely balanced out the broad technology correction. Um, DAX and France, they're doing quite well. Even though there's been a technical relief bounce, they crawled back into positive territory, especially of domestic value rotation as well as travel and transportation. So even in the UK, they're also capitalizing off the energy upstream, of course, all the commodities as well as oil bringing everything up. But if you want to take a look at the main stories or the main theme for Europe overnight, global semi and AI sectors, they basically faced an intense valuation shakeout. After SK Hynix debut last Friday, it actually plummeted like about 15.3% in Seoul, Korea. So that triggered a sell news dynamic among all the European. You saw Infineon down by nearly 2%. Traders were fearing a little bit of less capex or capital expenditure for data centers, especially ahead of key earnings this week in that region. And then on the other side, you've got, of course, oil. Oil surging more than 4%. Brent crude up like to $79 a barrel now. WTI $75. So this definitely rapid spike reignited eurozone stagflation risk. We see also some of the travel commodities like all the airlines. They fell sharply, especially in the day. We've got Lufthansa, Ryanair, TUI, all dropping between the ranges of 1.2 to 2.3%. This is going to be the last week of World Cup. Imagine at the end of the week how much those airplane ticket prices are going to be. And finally, with all the energy and natural resources segments, they fought a little bit of a defensive bid. London's FTSE, the UK did pretty much okay. I mean, they were down, but not too much, nearly flat. We had BP, Shell, and Total Energies. They were all up by nearly 2% on each front. So we'll see how the week goes, but all in all, it's been quite a defensive bid for Europe.
And you mentioned earnings, and we're going to get ASML earnings, of course, in that European space. That's going to be coming through on Wednesday morning. So lots of overlap here between these European and U.S. markets. If you want more insights from one of those regional markets, you're in luck because at 3:30 p.m. every day, this is 11:30 a.m. segment. He's going to take us through the for Asian markets.
I'll go over a couple of things if you.
Yeah, no, nothing.
Very, very valid point, Don. And it's very important to remind everyone that your Greek metrics, when I'm just going on with our spiel about delta, is always changing. It's always fluctuating with the underlying asset. So something that may be a 50 delta 1 minute, 20 minutes from now, it can be deeply in the money and change to 70 or 65 or something. Even your theta and your gamma is always going to be fluctuating. Gamma's at its greatest at the money. Now, entry-wise, now we're going to go over a quick thing here on open interest. And I know Ozan and we got Trapman for real and everyone else who's been trading options. What we look at here is our open interest. Why am I looking at these levels? Well, and we'll get into gamma exposure momentarily, but there's multiple ways that we can register the same information, but take it in a different perspective, all right? So Ozan and I are looking at the exact same strike prices, but we may interpret it a little bit different. But essentially, it's the same objective. So what I'm getting at here with open interest is that when we go through our strike prices and we try to identify call and put walls, well, what we're looking at is the way that I interpret it is supply zones. Now, what do I mean by this is that when you have options contracts, you're not creating liquidity. It's actually liquidity that's already on the open market. So that's where you need to really understand your obligations and your rights. Those are two different things, all right? If you're on the short side of things, you're obligated. And if you are on the long side of things, whether it be a put or a call, you have rights, okay? So what we have here at this $105, we'll go over this example, sorry, at this 135 level, is we have a bunch of supply. Now, why am I referring to this? Because it may have that magnet effect because you're sitting on a bunch of negative gamma. But what also might be there is you have people on the opposite end of the trade. So this is a supply zone. We'll make it simple. I'll put it into layman terms. This is a supply zone. And we know with supply, in order to breach and head into the exact same direction, you're going to need more demand. Now, if the demand isn't there, you could see potentially rejection. So at 135, there's a supply zone of 24,000 contracts. This is already outstanding information. This is already outstanding shares with no new liquidity. Now, if we don't absorb this, this is where you can find a support level, okay? Now, if you go to the opposite end of things and find the resistance zone, we would be looking at a supply zone in the call sector, or in the call section, and that's when we fall into NVDA.
All right,
now, we're getting to game of something that Ozane is looking at.
I am
When
done.
you have an
Bye.
outstanding amount of open interest, they have exposure